7 of the most powerful financial institutions on Wall Street just filed paperwork with the SEC for spot XRP ETFs, all before a single March 27th deadline. Not one, not two, 7. And while retail investors are sitting on the sideline watching XRP trade at $1.40, down 61% from its all-time high, the institutions that manage trillions of dollars in assets are racing each other to get their XRP products registered and ready. Here's the question you should be asking right now. Why the rush? Why 7 firms? Why March 27th? And what does it mean for every XRP holder watching this? Stay with me, because what I'm about to show you is not what the media is reporting, and it's not what the XRP influencers on social media are focused on. This is the institutional mechanics underneath the surface, the real signal. If you watched my last video, you already know that XRP is sitting on what I called the biggest contradiction in crypto right now. The fundamentals are screaming bullish. Regulatory clarity, institutional filings, supply compression, and yet the price is at $1.40, down 61% from the all-time high of $3.65. That video asked the question, why? Today we go deeper. We're not just asking why anymore. We're looking at the exact mechanical trigger that resolves it and the specific deadline that puts everything in motion. Because here's what most retail investors are doing right now. They're watching the price. And the price at $1.40 feels like nothing is happening. It feels like the narrative failed. But while you're watching the price, the institutions are watching the infrastructure. And those are two completely different games. The $1.40 you're staring at is retail sentiment. It's fear. It's impatience. It's people who don't understand the mechanics selling to the people who do. Because the people who do understand the mechanics, they just filed 7 spot XRP ETFs with the SEC before a single regulatory deadline. In coordinated fashion. Not because they think XRP might go up, but because they've already done the math. And the math tells them the supply shock that's coming is unlike anything this market has seen since January 2024. That's what we're unpacking today. Not the hopium, the mechanics. And if you haven't seen the last video yet, I'll link it at the end. Watch them together. They're designed to be a complete picture. Let's talk about March 27th. Because I've seen a lot of content treating this date like it's a simple approval deadline. Like the SEC either says yes or no, and then we all move on. That's not what March 27th is. March 27th is the outer boundary of the SEC's statutory review window for the 7th and final XRP ETF filing in this current wave. When a firm files a spot ETF application, the SEC has a defined review timeline. They can accelerate it, they can extend it, but that date represents the hard wall, the outer limit of when a decision must come. And here's what makes this specific window so significant. All 7 filings are converging within weeks of each other. That is not a coincidence. These firms know each other's timelines. They know how the SEC's review clock works. And they all filed in a sequence that puts their products in position to launch within the same institutional window. Think of it like this. Imagine 7 runners in a race, and the race organizers have to start the clock for each runner when they step on the track. But if all 7 runners step on the track within the same 30-day window, the gun effectively fires for everyone at the same time. That's March 27th. It's not just a deadline, it's a starting gun. And Wall Street knows exactly what happens when that gun fires, because they've seen this movie before. So who are the 7 filers? We're talking about Canary Capital, who moved first and fast. Franklin Templeton, Grayscale, Wisdom Tree, Bitwise, 21 Shares, and Fidelity. Read that list again. These are not small crypto-native shops trying to get a product to market. These are trillion-dollar asset management firms with institutional distribution networks, pension fund relationships, and compliance infrastructure that took years to build. When Fidelity files a spot XRP ETF, they are not speculating. They are executing a strategy that has already been approved at the highest levels of their investment committee. And here's what the Bitcoin comparison tells us. When Bitcoin spot ETF launched in January 2024, it pulled in $164 million on day one. Within 35 consecutive days of net inflows, it had accumulated $1.44 billion in assets. Goldman Sachs alone put $154 million into Bitcoin ETF products in a single reporting period. Now ask yourself, if 7 firms filed spot XRP ETFs, and even half of them replicate that kind of institutional demand, what happens to a circulating supply that has already dropped from 4 billion XRP to 2.6 billion XRP? That's the math Wall Street has already done, and that's why they filed before the deadline. Let me break down the supply mechanics, because this is the part most retail investors completely miss. Bitcoin's spot ETF launch created what the market calls a supply shock. The ETFs were buying Bitcoin faster than it could be mined. And when demand exceeds available supply, price doesn't just go up, it accelerates. Because every dollar of new institutional demand is chasing a shrinking pool of available coins. XRP's setup is structurally more extreme. Here's why. Bitcoin's supply is capped at 21 million. That's well known. But XRP's total supply is 100 billion, which sounds enormous. Except that the circulating supply has already been significantly reduced through Ripple's escrow release schedule and the locked tokens that never hit the open market. We've gone from approximately 4 billion XRP available on the open market to roughly 2.6 billion. Now layer 7 institutional ETF products on top of a 2.6 billion coin float. If the largest players in this space enter the XRP ETF market and hit even a fraction of their Bitcoin ETF AUM, the internal models at institutions suggest a $3 billion inflow threshold could reprice XRP dramatically. The current AUM across all XRP ETF products sits near $1 billion. We are at the starting line, not the finish line. Now let me give you the regulatory foundation underneath all of this, because without the legal infrastructure, none of the ETF activity we just discussed would be possible. On March 17th, 2026, the SEC and CFTC jointly issued a landmark ruling that designated 16 specific digital assets as commodities under existing U.S. law. This is what we've been calling the Clean 16 framework inside the smart money ecosystem. XRP is on that list. So is Ethereum. So is Bitcoin, along with Polkadot, Algorand, and 11 others. Why does this matter for the ETF filings? Because when a regulator formally classifies an asset as a commodity, it removes the legal ambiguity that previously made institutional participation dangerous. An asset manager cannot take a fiduciary risk on an asset whose legal status is unclear. The moment XRP was formally designated as a digital commodity, not a security, the institutional green light turned on. And then the Clarity Act gave it a legislative backbone. The Clarity Act isn't just regulatory guidance, it's a congressional framework that defines how digital commodities are regulated going forward, which regulator has jurisdiction, and what standards ETF issuers must meet to get their products to market. 7 firms filed spot XRP ETFs after the Clean 16 ruling, and within the Clarity Act framework. That sequencing is not an accident. That is institutions executing the moment the legal structure allowed them to. Here's something I want you to understand about how institutions move, because it's fundamentally different from how retail investors move. Retail investors react to price. Institutions front-run regulatory clarity. When Bitcoin was trading sideways in 2023, retail was bored. Institutions were filing ETF applications, building custody infrastructure, and negotiating seed capital commitments. By the time the Bitcoin ETF launched in January 2024 and the price moved, retail thought it came out of nowhere. It didn't. The institutions had been positioning for 18 months. XRP is following the same pattern. The price at $1.40 feels like nothing is happening. But underneath the surface, 7 major asset managers have just committed their legal and compliance resources, which cost tens of millions of dollars, to get XRP ETF products registered. You do not spend that kind of money on a speculative bet. You spend it when you've already done the math and you know the capital flows are coming. The 35-day net inflow streak on Bitcoin's ETF after launch, that was not retail investors buying. That was institutional capital. Pension funds, family offices, sovereign wealth funds, executing allocations they had already approved. Retail followed after the move had already begun. That's the dynamic we're watching set up right now with XRP. And March 27th is the date where the first dominoes fall. So what actually happens after March 27th? Let me give you the realistic sequence. The SEC has 3 options for each of the 7 filings. They can approve, they can deny, or they can extend their review window. In the current regulatory environment, post-Clean 16, post-Clarity Act, with a pro-digital assets administration in place, an outright denial is the least likely outcome in the history of XRP's relationship with US regulators. What's more likely is a staggered approval sequence. The SEC approves 1 or 2 products first, likely the ones with the most robust custody and liquidity frameworks, and the others follow within weeks. This is exactly what happened with the Bitcoin ETFs. BlackRock and Fidelity got approved first, and the market treated those approvals as the trigger for institutional capital deployment. When the first spot XRP ETF receives final approval and begins trading, 3 things happen simultaneously. First, the institutional inflow clock starts. Day 1 capital flows in from pre-committed seed investors, which for the larger funds could be 8-figure numbers on opening day alone. Second, the supply compression begins. Every XRP held inside an ETF structure is effectively removed from the open market. It cannot be sold by retail. It cannot be borrowed by traders. It sits in custody. And with 2.6 billion XRP in the float, even modest ETF AUM growth creates real supply pressure. Third, and this is the part retail investors always underestimate, the media cycle kicks in. When CNBC reports that the first US spot XRP ETF launched today and pulled in $164 million on day 1, every retail investor who was on the sideline suddenly wants in. That's the FOMO wave, and by the time it hits, the institutions are already positioned. So let's bring this home. What does all of this mean for you? Right now, today, watching this video. Here's the honest answer. Nobody can tell you the exact date the first XRP ETF gets approved. Nobody can tell you the exact price it triggers. Anyone who gives you a precise price target with a precise date is selling you certainty that doesn't exist. What I can tell you is this: $7 trillion institutions did not spend tens of millions of dollars in legal and compliance costs to file spot XRP ETF applications because they thought XRP might go up a little. They filed because their internal models, built on the Bitcoin ETF precedent, the supply mechanics, the regulatory clarity from the Clean 16 ruling, and the Clarity Act framework, told them this is a high conviction, asymmetric opportunity. XRP at $1.40 with 7 spot ETFs converging on a March 27th deadline is not a failed trade. It's a compressed spring. The question isn't whether the institutions are right. The question is whether you're going to be positioned when the spring releases or whether you're going to be watching from the sideline when CNBC runs the headline. Smart money made their decision months ago. The window for retail to get ahead of this is still open. But windows don't stay open forever. Here's your takeaway from today. 7 spot XRP ETF filings. 1 March 27th convergence deadline. A supply that has already dropped from 4 billion to 2.6 billion XRP. A regulatory foundation built on the Clean 16 designation and the Clarity Act. And an institutional playbook that mirrors almost exactly the Bitcoin ETF setup that preceded one of the most significant institutional capital events in crypto history. The mechanics are in place, the infrastructure is being built, and the institutions are already positioned. If you found this breakdown valuable, subscribe to Crypto Corner with Steve. This is the smart money ecosystem, institutional grade research delivered to retail investors who refuse to be left behind. Drop a comment below and tell me, are you positioned in XRP ahead of the ETF approvals, or are you still watching from the sideline? I read every single comment, and the most asked question becomes the next dedicated video. I'll see you in the next one.